You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, it is earnings season, but I should let you know probably right away that we are taping on Wednesday, October 28th. That means it's been a crazy day in the markets. We've seen the VIX index rise up above 40, kind of hanging around that level, and we've seen the Dow Jones Industrial Average down about 900 points. A lot of the FAANG stocks have gone down, and they are going to be announcing earnings this week. So there's actually, I think, more volatility in the FAANG stocks than we probably would expect to see after the earnings announcement. So with all that said, let's look at last week's trade. We did have the kickoff of the FAANG stocks. We've had Netflix announce earnings. We've also had Microsoft. And last week we looked at a back spread in Microsoft. And I talked a little bit about how I was looking to do a more out-of-the-money skip strike butterfly, but it just didn't look enticing. And usually when that's the case, well, then I'm saying, well, if the marketplace isn't allowing me to get my skip strike on for a decent credit, let's do something completely opposite. And that's actually what we did. And my completely opposite trade is an at-the-money back spread. And we did that trade for a net credit to the account. Now, as always on Options Playbook Radio, nothing's meant to be a recommendation, and we're not really forecasting directions on underlying stocks. So we flipped a coin. We decided to go bullish and use the call options. But on a back spread, just in general, you really don't care what happens to the underlying as long as it happens big, and that's what we're looking for. So we did the trade, brought in a net credit. So if the market went down, the maximum we could make is that net credit, and if the market went up, we were long one more call than we were short. So unlimited upside. So we'd like basically Microsoft to go to the infinity on the upside, and guess what? None of those happened, but we did have a decent move overall in Microsoft, and it has a lot to do with the volatility of the marketplace just today. So let me rehash that before I get into a rinse and repeat, and we're going to call this week's edition Having Fun with FAANG Stocks Around Earnings. So if we shorten that, it's just Fun with FAANGs. I think that's a good title for today. Let's get back into the Microsoft. So here's what last week, 7 days ago, we taped a show about Microsoft. The underlying stock had closed on that day at $215.74. It was up about $1 on the day. And we looked at what the expected move was in Microsoft for that day, and we knew that it was approximately 10 points. And what was really interesting here is that when we looked at the back ratio spread, we did it 9 days out because we had to contain earnings. And usually, a lot of times when we're doing these earning trades, I always feel the need to tell you this, that I would really just look at it on the day of earnings. We're going to talk about these back spreads in Apple, and we're going to actually look at one on Facebook too. But we would normally wait till the day of earnings and then look to try to see where the markets are at and put the position on. But we have the disadvantage of taping Options Playbook Radio at the same time every week. So we got to deal with the numbers that we have. So last week when we were looking at this, the underlying stock before their earnings announcement was trading at 215.74 on the day that we chose to look at this. We went out 9 days, and the main reason why we went out 9 days is because we could and still get a decent net credit to the account. We sold with the stock at 215. It's 216. Let's round it up a little bit, give Microsoft a quarter there to the upside. So around 216, we were able to sell one October 30th expiration 210 call and use those proceeds to pay for two October 30th 220 calls. And we did this for a net credit to the account of $1.40. Okay, so we knew Microsoft was expecting, I guess it was about 11-point move to the upside just overall, stock at 215. A decent move is what the at-the-money long straddle was trading for, which is often referred to as the expected move, for those of you that did not know. And in this instance, the underlying stock actually ran down a little bit, so it came closer to the 210 strike before it was all said and done. So after markets on the 27th, Microsoft announced earnings. The stock was closed on that day, the day before the day of the actual announcement, at 213.25. We had it open at 210.33, which was kind of okay. That's where our short strike was. We wanted it to continue on down, which would be the ideal scenario overall. And this actually kind of helped us out a little bit, the news and everything that has happened so far. And so we did actually see the underlying market go down. And on the 28th, we had a close at 202.68. So I quickly got a quote on it, and I saw that with the volatility crunch that we have obviously had after the earnings announcement, and the fact that the markets have gone down and that helped push Microsoft down even a little bit more, we could actually close this trade out for a 30-cent midpoint debit to the account. So you put the trade on, sold it for 140, could close it out for 30 cents right now, and I would just do that. The markets are crazy overall. So you went through the trade looking for a move to the upside. It didn't happen, but because of the way we set up the trade, we got a move to the downside and actually made a fairly profitable trade. I mean, the width between the spreads were 10 points, so you had $1,000 up front minus the 140 credit you brought in, so $8.60 or $860 for every 1x2 that you did. And just close it out. Interesting enough, just go and close it out. So we had that move to the downside, helped by just a downturn in the marketplace overall. The open to close scenario really wasn't a big gap in either direction, and that's usually a bad thing for setting up an at the money or close to the money back spread. So overall, that's a little bit more of your concern. Now, we did have 9 days. We still have a couple of days left in trading, which would help if we were wrong and the underlying stayed right where the short, or I should say the strike that we purchased was at. And you still want to get out. I mean, these are earnings plays. So after the earnings announcement, usually before noon, I want to be out of that trade. And more than likely, I'm going to be out if on Eastern Standard Time, be somewhere between 10 o'clock and 12 o'clock. Just see what's going on with the underlying stock and make your decision. But you're trading this as a purely speculative bet around earnings. All right. Now, I don't want to rehash that one too much. That one's fairly simple because the trade was profitable. It's just quite simple and quite easy to do. So now let's go and look at having fun with FAANG. Okay, so I just decided, I'm like, well, that was kind of fun. That was an interesting trade. We learned a lot about option pricing and a lot of stuff that can happen when you're doing these back ratios around earnings. Why don't we do a rinse and repeat? And I thought, I'm like, well, I'll do one on Apple, but then I thought, well, why not Facebook? And so we're going to do one on both of them. We're going to have some fun. We're going to do a bearish trade on Facebook and a bullish trade on Apple. So ideally, if you think about it, there's going to be a lot of volatility in the marketplace in general, just because the VIX is over 40 now, or trading around 40 right now. And we also have like every tech stock announcing earnings on the 29th. So we got Amazon, Apple, Facebook, Google, just to name a few. We had a bunch of stocks announce earnings after the close today, too. So it's just a very, especially tech-heavy earnings announcement week. So let's look at it because it's going to be a little bit of a long show because I'm just going to look at two trades. So let's just jump right into the trades. Apple today closed down $5.40, trading at 111.20. We have increased implied volatility because of the earnings. I'm just going to do the shorter term. You could go a little bit longer, give you a little bit more time to maybe adjust the trade if you wanted to, but I'm just going to, like I said, I'm having fun. This is going to be a speculation trade, not meant to be a recommendation at all, but it'll be a fun conversation because these options will expire before next week's show, and I'll make sure to look at it at the end of the day and see where they ended up at. So, we are selling one October 30th expiration 106 call option. That's a deep in the money call relative. And we're going to buy a couple kind of at the money, just out of the money, let me say, 112 call options. So we're selling the 106, we're buying the 112, and we can get this done for a net credit of $1.10 to the account. We're 6 points wide. That would be the requirement here would be those 6 points. So that's $600, but we're bringing in $1.10 net credit to the account. So if we do this trade, our capital that we have to have in the account would be $4.90 or $490 for every 1/2 back ratio spread that we did here. Now, in order to lose the maximum on this, though, what would have to happen is they'd have to announce earnings, and the underlying stock would have to stop right at 112. And if the market went on up, well, we're long one more call than we're short, so that's a good thing. We would ideally like this underlying stock to skyrocket to the upside, go more than the expected move, which I actually didn't think I mentioned that. The expected move in Apple is 6 points. Yeah, that's the reason why the spread is 6 points wide, actually. Usually kind of works out that way. So that's the expected move. We're hoping that it moves to the upside, at least that, and then some we'd be happy with. But if not, if we are incorrect, we hope that it will move at least that to the downside is what we're looking for here. If it lands somewhere in the middle, especially if it opens up and it's not really doing anything, I just close the trade out before you have that maximum risk come into play. You would just be looking to close it out and salvage whatever you could, knowing that your max risk on this trade is $490 total. And that's only if it stops right at 112 at the end of the trading day on the 30th. All right, that's our bullish trade. Okay, Facebook. Let's do the same thing, but let's be bearish on it. Now, Facebook's a little bit tougher because the expected move is wider and it's a more expensive stock. So ideally, if we're going to kind of look at both of these, I would want to put up the same amount of capital. So on the Apple trade as a paper trade, we're going to want to do 2 of those ratio spreads because that's going to be about the same margin as 1 back ratio spread with puts on Facebook. So now we're just saying that one of these stocks has to go down. Let's flip a coin. Let's say Apple is going to go up and Facebook is going to go down. But if they both go down or they both go up, we're safe in any direction. We just need it to move. We need it to do at least the expected move. The expected move in Facebook is right around $18 by looking at the money long straddle on the October 30th expiration. So here in this trade, what we're looking to do, Facebook closed at 267.67. That's fun to say. That's what I talk about, fun with FAANGs right there. So we closed at 267.67, down $15.62, which was about 5.5%, which most of the FAANG stocks or tech stocks today were down about 5% in general. And so if we look at this underlying, we're going to have to go wider, and it's usually you got to go about as wide as the expected move in order to get this done for a decent net credit. We're not quite there. Actually we are. Now that I look at it, I guess I was going to say it's less than 18, but it's not much. It's only 50 cents less. So we're selling that October 30th expiration, 287.50 put. $287.50, $287.50 strike put, and we're going to buy the 270 here in this scenario. Now the underlying market is at 267.67 is what I'm showing here. So in this instance, if we're doing this, we're going to be buying a little bit in the money put. We need the market to go down to at least. We want it to go below 270 and stay there and continue on down. And I can actually get this one done at the midpoint for a net credit of $1.72 to the account. So it's a little bit riskier trade. And overall, I kind of like to do it on a lower value stock because you just don't have so much upfront risk. But in Apple, we're just going to do two of them, right? So we're going to do two, and we're going to compare approximately the same amount of capital, and see which trade does better. Or it's very possible, that's likely that both trades could be winners after their earnings announcement. So the width between the strikes is 287.50 minus 270. That's $17.75. Minus, if we get a midpoint fill, which is never guaranteed, 172. That means that our margin, or what we have to put up, is $15.78 or $1,578 overall. Okay, so what do we want to happen if we do this? Well, we're long one more put than we are short. So we're really looking for that expected move. We need that move to the downside, or we want it to the upside, either or. The best case scenario is to the downside, and if we could get double the expected move to the downside, well then you're doing extremely well. But you're at least looking for an 18-point move. If you don't think that Facebook can do an 18-point move after earnings, you simply just don't do the trade because it's very hard to be profitable on it, especially considering that we're doing the 30-day expiration, so it's really an all-or-nothing trade. Once again, not meant to be a recommendation, but we're just having fun with FAANGs during their earnings, and that's exactly what we're looking at here. So a little bit long in the tooth, but I think this is just going to be a fun week. If you do consider yourself a trader, you will probably be trading on the 30th of October because it just should be a very interesting day. Markets should definitely go somewhere. All right, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. A lot of my educational events I'm tweeting about, more so than I ever have. You can follow me on Twitter. It's just at Brian Overby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out. Go vote.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.